Hi everyone, good morning. My name is Deepak Bisht, and today we are going to start with uh, the concept free cash flow to equity. Just give me a moment. Just switching in between slides. Okay. Okay, so previously we have completed the free cash flow and the free cash flow to firm concept. Uh, Today we are going to start with cash flow to equity. So let us begin. So the core idea of free cash flow to equity is the cash flow that belongs to equity shareholders. Since it's in the name only, the cash flow which belongs to the equity shareholders after the company has fulfilled all necessary financial obligations. And these obligations actually include the operating expenses, taxes, capital expenditure, working capital needs, and debt obligations. And after paying all the above, all these obligations, whatsoever cash remains, that cash actually belongs to the equity shareholders, and that remaining cash is called a free cash flow to equity. So operating expenses, taxes, capital expenses, capital expenditures, working capital needs, and debt obligations. And after that, whatsoever we are left with, that's called the free cash flow to the equity holders. And equity holders are actually the owners of the company. Equity itself represents ownership. And being the owner of the company, you enjoy the upside, but you also have uh, a claim. You actually also get a taste of things when things go downside. So you have the residual claim after the debt owners and other capital requirements are satisfied. So whatsoever you are left with, so that's the cash flow to equity. The key question that actually free cash flow to equity answers is how much cash can a company give to its shareholders without harming future operations or growth, without harming its operation and growth plans. And this cash can be used or can be dividend, uh, paid as dividend, used for share buyouts, or it could be reinvested, which again increases the shareholders' value. I hope this much is clear. The basic concept of free cash flow is to the equity. So the important things which I would want to emphasize on is that free cash flow to equity is cash but not profit. So it's the first thing is that free cash flow to equity is cash. It's about cash, free cash flow. It's not about profit. Free cash flow to equity belongs to equity shareholders only, not to debt holders. And the third point would be that free cash flow to equity reflects true shareholders' capacity. Okay, so let's move to uh, the second step. we were going to decide. Okay, so why free cash flow to equity is needed instead of profit? And many students would ask, why can't we just use profit rather than cash flow? And the answer lies in the limitation of accounting profit. So the problem with accounting profit is that it actually includes non-cash expenses. So profit actually includes non-cash expenses. So profit, when we talk about profit, and so profit actually includes non-cash expenses. The non-cash expenses are depreciation and amortization. The second problem with the accounting profit is that it actually ignores capital expenditure. Yes, profit, it actually ignores capital expenditure. The third problem is that it do not reflect the cash tied up in working capital. So do not reflect cash tied up in working cap working capital, and also it does not account for debt repayments. So debt repayments, profit do not account for debt repayment. Neither does it reflect cash tied up in working capital. It ignores capital expenditure and it includes non-cash expenses. So that's why we are going to give preference to cash. We are talking about cash. We are not talking about profit. And as a result, for because of that, a company might show high profits, but still have no cash, no cash to pay its shareholders actually. So if we are relying on profits, then there is a possibility that the company might show high profits, but still they do not have any cash to pay to the shareholders. And FCFE corrects all these problems by focusing only on the real cash movement. So the important things about FCFE is that FCFE reflects the shareholders' perspective. What does that mean is that FCFE considers only equity shareholders. It actually excludes cash meant for lenders. It also focuses on what owners of the business actually receive, and this makes FCFE ideal for equity valuations and shareholders' decision making. The second point here is that it supports in the intrinsic valuation. So free cash flow to equity is discounted using the cost of equity to find the intrinsic value of the equity. Since we are talking about equity, not about firm. So previously when we talked about free cash flow to firm, this we were discounting by weighted average cost of capital. But when we talk about free cash flow to equity, we are going to discount it using the cost of equity only. So this is something you need to pay attention to. So you never discount free cash flow to equity with WACC. And free cash flow to equity is the cash which is available to equity holders only. Here, the free cash flow to firm is available to both equity as well as debt holders. Never get confused in between in this. Weighted average cost of capital is the average cost of the whole capital structure, and the capital structure includes debt plus equity. So cost of equity, cost of debt, you multiply them by weight of equity, weight of debt, and you multiply the cost of equity with 1 minus tax rate because of the tax shield which comes with debt and we add these. However, on the other hand, when we talk about free cash flow to equity, cost of equity is simply the cost. It's simply the cost of equity. Uh, so it actually supports the intrinsic valuation. So this means that no need to estimate dividends, no dependency on dividend policy. And even if company does not pay dividends, free cash flow to equity still works. The third point here is that it adjusts for leveraged decisions. So free cash flow to equity directly includes new borrowings and debt repayments. So any changes in the capital structure immediately affects the FCFE and it reflects real financial decisions. And point number four here is that it improves dividend analysis. So it reveals dividend capacity, free cash flow to equity, and a company may choose not to pay dividends, but free cash flow to equity shows that whether it can afford to pay dividends or not. So this means free cash flow to equity is not equal to dividends, but free cash flow to equity is it's about dividend paying capacity. So you always do not pay dividends from free cash flow to equity. If you have surplus, then only you pay dividends. But the FCFE actually is the deciding factor, the capacity of dividend paying. I hope this much is clear. So, okay, let's move to the next point. How is FCFE different from accounting profit? So let's now carefully study this table here. So accounting profit is based on accrual accounting. It actually includes accrual accounting. And the free cash flow to equity is based on cash flows. So actually, it's based on actual cash flows. When we talk about accounting profit, the accounting profit it includes non-cash items like capital expenditure impact. But free cash flow to equity actually excludes non-cash expenses, non-cash effects. When we talk about the accounting profit, the accounting profit is not shareholder specific, but free cash flow to equity, as it's in the name only, so it's equity specific. So accrual versus accounting, accrual versus cash means that accounting profit records revenue even if the cash is not received. However, FCFE records only actual cash, the cash inflow and the outflow. Non-cash expenses items means that depreciation reduces profit but does not reduces cash. But free cash flow actually adds it back. When we talk about capital expenditure, the impact of capital expenditure, the accounting profit actually ignores long-term investment trending, but the free cash flow to firm, the free cash flow to equity, the free cash flow equity, FCFE actually subtract capital expenditure because it uses cash. So it's considered to be a cash outflow. That's why capital expenditure is subtracted from free cash flow to equity. And the owners, when we talk about the ownership, accounting profit belongs to the whole firm. However, the free cash flow to equity only belongs to the equity holders. And the the key learning here is that high profit does not guarantee high free cash flow to equity. Yes. There is an example. A company may report higher profits but negative free cash flow to equity due to heavy capital investments. Yes, this can happen. So we have discussed about the table here, and we are now going to start with the formula for free cash flow to equity. There are two commonly used approaches. Okay, the main formula here is that the free cash flow to equity is equals to, it starts with net income. We add back depreciation, we subtract capital expenditure. We add back the non-cash expense. This is non-cash, and the capital expenditure, which is a cash outflow. We subtract the changes in working capital because in the increase in working capital is a use of cash, and we add back the net borrowing because this is again a cash inflow. So net income, we start with net income, and net income is the profit after interest and taxes, and it already belongs to the equity holders, equity shareholders. It is the starting point for FCFE, free cash flow to equity. And however, net income includes non-cash items also. Net income actually ignores the investment needs. So we need to adjust the net income for those things. And for that, the first step which we do is we add back the depreciation. Depreciation and amortization actually reduces the profit, but this cash never actually goes out. So that's why depreciation is always added back. We add back depreciation, amortization because these are non-cash expenses. And non-cash expenses, if you are not from the commerce background or if you are new to this series or you do not have any relevant experience with finances, so non-cash expenses are those expenses uh, where the cash never leaves the organization. And depreciation and amortization is an example of that. And why does this happen? Why do we add back depreciation? Because free cash flow to equity actually measures cash, not accounting expenses. And we discussed about this when we were discussing in the initial introduction when we were talking about free cash flow to equity, the features. So this we are not focused on the accounting expenses, but we are more focused on cash. So here the cash never left the organization, and this is so that's why we have actually added it back. This is a non-cash expense. Now the second step, the then another step is capital expenditure. So when we talk about capital expenditure here, so capital expenditure is spent on machineries, it's spent on buildings, it's spent on technology, and capital expenditure actually uses real cash. And that's why we subtract capital expenditure because capital expenditure actually lowers it actually because of high capital expenditure your FCFE also falls. Free cash flow, your free cash flow to equity actually falls. So that's why this is a cash outflow, and it's that's why we subtract capital expenditure. If you are able to remember the elements, these elements, you do not need to remember whether or not you should add it back or you should uh, subtract them, because if you understand the nature of these items then you will be able to figure out whether you need to add them or subtract them. So depreciation is a non-cash expense, so the money never left the organization, and the money never left the firm, that's why we added back. When we talk about capital expenditure is a expense in itself. The nature is expense, and this represents a cash outflow. That's why we subtract it. When we talk about working capital, the working capital is a cash expense. It's again expense. So working capital requirements to run our daily operations. It's a cash outflow. That's why we subtract it. And net borrowings, when we are borrowing money, into the organization. So it will represent a cash inflow, and net borrowings, that's why it's added back. I hope this is making sense and this is clear to you. Okay, so let's talk about changes in working capital. When, when we talk about changes in working capital, the f- uh, the formula for working capital is current assets. We subtract the current liabilities. If the working capital in there is an increase in working capital, the cash is blocked, means it's a cash outflow. And if there is a decrease in working capital, this means that the cash is released, and this is in cash inflow. Therefore, increase in working capital is subtracted and the decrease in working capital is added back. And the last element here is the net borrowing. So net borrowing is actually the net debt, and we do some repayments. So new debt. We subtract the debt repayments, and new borrowings bring in new cash inflow, and debt repayment uses cash. So net borrowings is the overall effect is positive, and that's why it's added back. You cannot repay more than you have the cash. So that's why net debt, the new debt, it's a bigger number, and the debt repayment is a lower number. So this actually gives a positive impact. So that's why net borrowings is actually added back into the equation. All right. I hope this much is clear to you. So free cash flow to firm, from free cash flow to equity, how it's different. Uh, and if you ever encounter a situation where you have actually calculated the free cash flow to equity, and now you can want to calculate the free cash flow to you have calculated the free cash flow to firm, and now you want to calculate the free cash flow to equity, then you can also do that. So there are adjustments, specific adjustments. Free cash flow to firm, how do we calculate that? Free cash flow to firm, we subtract the interest expense, we take out the tax shield, and we add back the net borrowings. And this approach is useful when free cash flow to firm is already calculated. So free cash flow to firm actually belongs to the whole debt plus equity, the whole firm. And to convert it into free cash flow to equity, what we do first is we subtract the tax interest rate. We subtract the after tax interest. So when we are multiplying the interest with 1 minus tax rate, we are actually subtracting the after tax interest. And then we add back net borrowings. Why have we subtracted the after tax interest rate? After tax interest. Why? So because after tax, so it's simple, it's very simple, it's very basic. Interest is a component, interest is a part of debt only. So we are going to subtract interest and after tax interest. That's why we actually multiply it with 1 minus tax rate. Pay attention here. Why we have, when we want to convert free cash flow to equity, and we want to convert into free cash flow to we have calculated free cash flow to firm, and we want to calculate it into free cash flow to equity, FCFF to FCFE, we are going to remove the impact of debt. And since interest is a part of debt, we are going to remove the interest component the after tax interest component. Then we add back the net borrowing. We add back the net borrowing. If you still have any problem understanding this thing, kindly feel free to post comments and I will be happy to answer those questions of yours. Free cash flow to firm to free cash flow to equity, you need to remove the impact of debt, which comes with interest expense. All right, so let's move to the next part and let's discuss about the interpretation of free cash flow to equity. So, free cash flow to equity, when we talk about free cash flow to equity, it means if the free cash flow to equity is positive, this means that the company is generating surplus cash and shareholders can receive dividends. The company can buy back shares from the market, and there is value appreciation means that it reduces equity risk as well as it increases the value for equity holders, and this is typical. This is actually this actually these things actually happen for stable industries or mature firms. Uh, when that free cash flow to equity is negative, so this means that the cash outflow exceeds cash inflow, and of this this often happens due to heavy investments and growth expansions. And negative free cash flow to equity is not always bad. And when we talk about Amazon, uh, so that we can understand it a little better, that's why I've included examples here in the free cash flow to equity concept. So when we talk about Amazon, so Amazon had free cash flow to equity, negative free cash flow to equity for many years. And while they were actually investing in logistics and technology, and they were creating enormous long-term shareholders value. And now, after many years, you all know about Amazon. Jeff Bezos. When we talk about free cash flow to equity and growing companies and growth companies, so growth companies actually invest heavily. They prioritize their expansion and sacrifice current FCFE. The common reasons are that they have high capital expenditure, they have raising working capital, and they actually have very low dividends, limited reliance on dividends. Expanding working capital is a heavy capital expenditure, and one example is Tesla. So Tesla reinvested all its cash into its gigafactories. It's R&D for battery technology and global expansion. And for many years, Tesla actually had a negative free cash flow to equity. And investors focused majorly on future free cash flow to equity and not current free cash flow to equity. And if you are heavily in reinvesting your cash, heavily reinvesting your money, the investors' money, then your company do have a negative free cash flow to equity. Free cash flow to equity in mature companies. When we talk about mature companies, so mature companies actually show stable operations and predictable free cash flow to equity. Uh, and examples are one example is Apple, the iPhone manufacturer. So Apple's strong free cash flow to equity comes from high margins, its limited capital expenditure, and strong brand power. And Apple actually uses its free cash flow to equity for dividends, large scale share buybacks, and uh, debt, the management of debt. And this makes free cash flow to equity a strong indicator for Apple's equity sustainability. Now, the next point here, which we need to discuss, is free cash flow to equity in valuations. So, free cash flow to equity works exactly like free cash flow to firm. So, free cash flow FCFE1, FCFE2, FCFE3. You discount all these back to the current year. You add them. Summation means you are adding summing up. So you sum FCF1, FCFE1, FCFE2, FCFE3. You add all these, you discount them by the cost of equity. You discount the sum by cost of equity. And this model actually values equity directly, and it actually avoids dividend assumptions. So equity valuation, free cash flow to equity. This approach is particularly useful when capital structure is unstable, debt levels change frequently, and dividend do not reflect true cash capacity. So this is useful in these three cases. There could be more cases, but as of now, we are only able to discuss the three cases. So capital structure is unstable. When the capital structure is unstable, when debt levels changes frequently, and when dividends do not reflect true cash payments. So these are the scenarios where we can use free cash flow to equity, and but usually in valuations we focus on free cash flow to firm. The comparison of dividend discount model versus free cash flow to equity. Here, yes, when we talk about dividend discount model and free cash flow to equity model, uh, the dividends are these are based on dividends, and dividend discount model is, yes, based on dividend, but free cash flow is not based on dividends. Reflects true capacity? No. Dividend discount model do not represent the true capacity. The true capacity is represented by free cash flow to equity, and we have discussed it previously in the upper section. Suitable for non-dividend firms? No, it's not suitable for non-dividend firms, but yes, FCFE is suitable for non-dividend firms also. And free cash flow to firm is more flexible and realistic than dividend discount model. So free cash flow to firm. But there are certain cases where we apply dividend discount models, and we will discuss about these cases when we will discuss about the valuation aspects. Okay. So now let's discuss about the impact of leverage on leverage on free cash flow to equity. So debt decisions affect free cash flow to equity. New debt actually increases the free cash flow to equity. High debt repayments reduces the free cash flow to equity, and high leverage also increases the risk of cost and equity. One example is Netflix. So Netflix actually borrowed heavily to fund content, and short-term free cash flow to equity increased, but the long-term free cash flow to equity depends on subscriber growth. So this actually shows free cash flow to equity must be analyzed alongside leverage risk. And there are certain limitations to free cash flow to equity also. When we talk about free cash flow, the limitations of free cash flow to equity, it's very much sensitive to the assumptions which were used to calculate the free cash flow. So it's sensitive to the assumptions, those are the assumptions which are used to forecast. Uh, Free cash flow to equity as well as free cash flow to firm, these are both sensitive to assumptions, and in fact all your forecasting and valuation is very sensitive to assumptions. It's volatile in cyclical markets. If the markets are cyclical in nature, it's volatile. It's the volatility increases when the markets are cyclical in nature. Let's say for cyclical firms, distorted by heavy leverages. And yes, distorted by heavy leverages because we are here adding the new net debt. So uh, distorted by heavy leverage, and it's very difficult to forecast also. So large debt repayments distort equity cash flow, and forecasting difficulty requires detailed projection of capital structure. So capital structure, every time you borrow more, so your capital structure changes, and that's why the data is very important aspect when it comes to forecasting. The practical use of free cash flow to equity is that it's used for equity analysis for valuations, investors assessing of dividend sustainability, and corporate managers evaluation of capital allocation. And private equity firms use this free cash flow to equity to estimate exit values. So the final summary and the conclusion here is that the free cash flow to equity actually measures the true cash available to shareholders after all the obligations are met. And the key final takeaways from this whole reading, this whole episode, is that free cash flow to equity is actually cash based. Uh, it actually it captures leverage and reinvestments, and it supports realistic equity valuation. And understanding free cash flow to equity is essential for financial modeling, equity valuation, and investment decision making. And one more last thing. When we talk about free cash flow to equity and free cash flow to firm, if we discuss about this table, so now understand this thing. Free cash flow to equity, the free cash flow to firm, which we have discussed previously in the previous episode, and the free cash flow to equity, which we are currently reading. So free cash flow to equity is the cash flow is available to the whole firm. This means the debt and the equity holders. And when we talk about free cash flow to equity, the cash is available to equity holders only, specifically to the equity holders, and it's also in the name, free cash flow to equity holders. And when we talk about free cash flow to firm, we discount it using weighted average cost of capital, and we discount free cash flow to equity only by using the cost of debt, because there is the cost of equity, because pardon me, because there is no debt component involved with it, and this free cash flow is only available to the equity holders. So, and capital structure, when we talk about the capital structure relevance, so capital structure is ignored in free cash flow to the firm, but it's included in the free cash flow to equity. And while free cash flow to the firm is capital structure neutral, free cash flow to the equity reflects real equity risk and rewards. I hope it's clear. I hope you have understand the concept and you have learned something of value today. All right, so let's wrap this session here. My name is Deepak Bisht, and I will see you in next reading, next episode. All the very best learning. Thank you.